Hi class, we're going to talk about the equity sections of different forms of organization today. Now, we're going to talk primarily about the commercial forms of organization structures, being the sole proprietorship, corporation, and the partnership. Obviously, there are lots of different kinds of organizations, including not-for-profits like hospitals, charitable organizations, churches, the Red Cross, you name it. We also have state and local governments, and each of these organizations will all have their own special kind or special nuances of the equity section. But we're going to confine ourselves to these three listed above. Further, even the ones listed here will have different permutations of the organizational structure. Corporations can be an S corporation, they can be a professional corporation, partnerships can be a limited partnership, and all kinds of different forms of these types of organizations. We're just going to go with the plain vanilla type of corporations and partnerships, and of course the sole proprietorship is pretty straightforward. In the sole proprietorship, all profits and contributions made by the owner are credited to the owner's capital account. Now, if the sole proprietorship has a loss, those losses are debited to the owner's capital account, and then all withdrawals are debited to the owner's drawing account. So it acts kind of like a dividends account. Let's move on to the corporation. That's where we get a little bit more sticky. Contributed capital includes the par value or stated value of the shares of stock purchased by investors, as well as the additional paid-in capital, and we list the preferred stock first, and then we go on to the common stock. After the contributed capital section, the retained earnings section is listed, indicating any portion that is appropriated or reserved by covenants. For example, the retained earnings may be appropriated for a future building project, and so it's carved out and set aside. Profits are credited to the retained earnings, while losses and dividends are debited to retained earnings. And then finally, if the corporation has purchased back any of its own stock, that treasury stock is reflected in the equity section until it's either resold, reissued, like in an employee stock ownership plan, or canceled. Let's look at the example of that. So here's an example of the corporate stockholders equity section. And again, we see that the preferred stock is listed first. It has an $8 par, and there are 1,000 shares authorized and issued and outstanding. So though we haven't acquired any of those back yet, so that's $8,000. But the people who bought those shares also paid $37,000 in additional paid-in capital. We move to the common stock section. We have 20,000 shares authorized. Does that show up over here? No. Just the ones that are issued. 10,000 shares at $1.50 par value gives us 15,000. And they paid some additional paid-in capital to acquire those 10,000 shares. Now, you'll notice that there are only 9,200 shares outstanding. So somewhere along the line, we decided we were going to purchase 800 shares of our own stock back. And so here are the 800 shares in the treasury at cost, $20,000. We'll talk, well, that is covered later on in the course. The retained earnings at this point is $31,000, but the point being is that right now we have an equity section equal to $141,000. Now, acquiring corporate stock. Stock, whether it's preferred or common, may be issued by the corporation in exchange for cash, property, intangible assets such as a trademark, or even in exchange for debt carried on the corporate book. So if we issued corporate convertible bonds, and then the bondholders decide they want to cash in their bonds and receive stock in exchange, then you would debit the bonds and credit the corporate stock. Stock may also be issued as compensation, such as in an employee stock ownership plan that we talked about before, profit sharing plans, or bonuses in the form of stock options. Now, these stock options are typically reserved for management, executives, and the board of directors. And it basically encourages those folks to make decisions that will enhance the value of the company. Thus, when they exercise the options, they tend to make money. Stocks issued by the corporation are referred to as the primary market. So when a company sells their own shares and they get money, that's the primary market, such as in the instance of an initial public offering, an IPO. But once the shares are out in the market and they are being traded by investors on the external market, that's called the secondary market. And this has no effect on the corporate books. Now, I say here that the secondary market has no direct effect on the corporation. What is the indirect effect? Obviously, if the shares start to plummet in their value, let's say that when BP had the huge Gulf oil spill back in, I think it was 2010, what happened with the BP stock? It fell something like 60% in a matter of months before they even paid out a dime. When that happens, then the shareholders start prevailing on the board of directors to do something to fix this problem, to fire the CEO and put somebody in there who can clean up the mess. And that's exactly what happened with BP, but that's what I mean by having no direct effect. Rather, the effect is indirect on the company when the secondary market changes. Now let's move on to partnerships. Just as with a sole proprietorship, each partner maintains a capital account and a drawing account. These accounts behave in the same way they do in a proprietorship. The challenge for the accountant comes when partners are either admitted to or leave the partnership. Financial exchanges may or may not affect the partnership accounts. For example, a partner wants to come into a 50-50 partnership, and he wants to be a 1/3 partner, so he's going to receive a 1/3 partnership equity, and he pays the existing partners outside the partnership for 1/6 of each of their ownership in the firm. So now each of the three partners will have a 1/3 interest in the partnership. Now, in this case, he's paid them outside the partnership, and there's no book entry on the books of the partnership. Instead, it's been all consummated outside the partnership. All you have to do is add the new partner's name to the capital section. There's no assets coming into the company. Now, in another case, the new partner could pay the firm for 1/3 of the existing capital for 1/3 of the ownership in the firm. And so in that case, you do have an infusion of capital. So you've got a debit to cash or other assets and a credit to the partner capital account. And then each of them have a 1/3. Now, let's look at an example of a partnership equity section. In this case, we've got the full balance sheet. The assets are listed up here. The liabilities are listed, and then you've got three owners, with one having less and one having more than the other two. So what's going on with this? They have unequal amounts of equity in the firm, and it could be due to a disparity in the way profits are distributed. Perhaps Raven is the senior partner and receives more of the income than the other two. The Eagle is perhaps a junior partner who just came into the firm and gets a smaller cut of the profits. Or it could be that these two have been in the company a lot longer and they've built up a greater share. Brown perhaps joined Raven after Raven had been in business for a while. And so their capital accounts are reflective of their ownership interest in the company. It could be that these two partners have withdrawn more money from the company than Raven has. And so in that case, we have that unequal distribution, and that's okay. We see that a lot. So these are the three types of organizations that we cover and how each of their equity sections are reflected in the balance sheets.